Okay, welcome back. Our corporate conversations continue. And the next company on our radar is Arvind Fashions. Now, that stock surged almost 10% yesterday after the company said it's raising 439 crore rupees from Marquee investors via the preferential allotment of equity shares. Now, with this fundraise, Arvind Fashions completes the capital requirement needed for growth and for navigating uncertainties. This is what we got to hear from the company. But let's get more color on this. Kulin Lalbhai, director of Arvind Fashions, is with us. Kulin, good morning. Good to have you on. First things first, what are you going to use the money for? And are you looking at more fundraising this year?
No, this capital raise, in a sense, completes a process which we had embarked on over the last 18 months of a reset and a recapitalization in the Arvind Fashions business. So what we have done is we have exited unstrategic businesses on one side so that we can focus on 6 marquee brands that we have, which are industry-leading brands. And on the other side, we have significantly strengthened the balance sheet of the company. So we have more than halved our debt over the last 12 months. And with this completion of the recapitalization, we will now be able to pursue profitable growth, enhance our return ratios, and also insulate the company from any sort of COVID-related uncertainties in the future.
Okay, that's great to hear, and I think that's something that shareholders have appreciated as well. But since you said that you've halved your debt, I think currently the debt stands at about 1,000 crores as of June 2021. That's the data that I have. Correct me if I'm wrong. And what is the plan to reduce debt further? Where would it be, say, by the end of this fiscal?
Yeah, so we are around 900 crores right now, and after this fundraise, and even though we will significantly grow in the second half of the year, we expect debt to go under 700 crores.
Okay. So, now let's talk about the business forward and these 6 brands that you're going to be sort of spending more time and effort on. What is your sense of demand? The thing is that even now, in a state like Maharashtra, malls have been a stop and start approach. It's largely e-commerce. So give us a sense of demand, and to what extent has e-commerce managed to replenish the lack of actual feet on street?
So let me start with the short term. I think in the short term, the good news is that the recovery in the second wave has been much faster than the first wave. So even in Q1, we were double the recovery of last year. And as we speak, in the month of July, August, our recoveries have reached close to 90% of pre-COVID levels. So I think the short-term recovery has been quite good. E-commerce has been a highlight for us. It's become, on a steady basis, more than 25% of the company revenue. We are at 1,000 crore run rate on digital sales, and it's a channel which has been growing more than 25-30%. So we are very strong believers in an omni-channel future. And the company has been investing in that very, very strongly. So I think that sets us for rapid growth in digital. And we do expect the second half of the year, as we come into festive and, as things are normalizing post-COVID, we do expect a near normal sort of demand situation. And in the medium term, we believe that the category itself is looking very exciting. Digital has opened up consumption across the pin codes of India. Products reach almost every pin code of the country now through digital. And even on the physical side, small town India is opening up, and we have plans to open 500 stores across these 6 brands of ours over the next 3 years. So I think short-term demand is looking good, and I think the medium-term opportunity also is quite exciting.
So when you say demand is looking good, can you give us some growth targets? I mean, the street definitely likes what they're seeing. The stock has gone up almost 65%, 70% in the last 6 months. So clearly, I'm sure you're focusing on big growth for the company. So over the next 1 to 2 years, what could the compounded growth look like?
So we believe that even though we are going to be focused on very profitable growth and significantly improving our ROCE, we believe that with the growth drivers we have, which is digital, retail expansion, and category expansion, the company should be able to clock a 15% cumulative average growth rate year on year.
We've spoken about growth. Let's talk about the bottom line as well, Kulin. Let's pull up the numbers once again for our viewers, because it was a challenging year, no doubt about that, FY21. The loss grew to 580 crores versus 400 crores in the previous year. I'm sure you're working hard to sort of change this. What's the turnaround plan, and do we see some evidence of that this year?
No, that's what I meant when I said we got onto a reset in the business. We were exiting quite a few businesses. So whenever you exit a business in retail, there are write-offs that come in. And then that was compounded by COVID. But, we've been able to bring in, around 1,400 crores of equity funds into the business to completely recapitalize and make up for these losses. And as we now have a clean portfolio of 6 profitable businesses, you will see very strong profitability coming in, from the second half of this year itself. We expect profitable growth. And as we move into next year and we have a non-COVID, financial performance coming through, the company will be profitable. In fact, we are expecting the business to throw out cash from the next year itself.
Okay, just wanted to understand a little bit about your online focus, because now is doing very well. You've picked up a lot of pace there. You're selling in other marketplaces as well, like Myntra, Flipkart, etc. The top 6 brands is what I'm talking about. But I want to know if the focus is more online, would you be looking to scale back on your offline physical presence on the physical stores?
No, as I was saying, I think digital is an opportunity in itself. And, there was a time when, digital was largely about selling older season stock, and that has completely changed. Today, we are building product ranges specifically for online, creating supply chains that are flexible and nimble so that the online consumer gets a plethora of choices. We are developing our direct to retail with now.com and also the marketplace model. We are omnifying our stores. So stores are no longer just offline. We use our stores to also fulfill online demand. And India is very early in the S-curve of demand. Our stores are in 200, 300 towns of the country today. And in the future, this townscape will itself grow to 1,000 cities. So as I mentioned, we'll be opening, close to 200 stores every year moving forward. So I think the offline side will also grow. Maybe the density of stores in urban India may not grow, but there is a lot of expansion that will come in growing into new cities as far as offline retail is concerned.
I just had one more question on how you plan to change your strategy, or if you plan to change your strategy, because some of these brands may not have as much relevance as before. I mean, Arrow, for example, into formal wear, right? People, since they're working more from home, I'm sure sales over there must have fallen. Also, a lot of your brands are premium brands, and now with this whole pandemic hitting, people's consumption patterns have changed. Perhaps people are looking for more low-value products. Would you change your strategy in any way?
Actually, we are very excited about the shape of our portfolio. As a company, our strength is the casual side. We have the leading casual wear brands in the country, and post-COVID, actually, that is what has benefited us with the US Polo, Tommy, Calvin Klein, Flying Machine. These are all structurally brands which are extremely strong on the casualization trend of India. And we have one strong formal wear brand. It's more than 30 years of legacy in heritage in India. And, it's not just a formal wear platform. We will be using that also for occasion wear and wedding, which is a very, very large market in India. And then we have Sephora on the cosmetic side, which is also a very exciting opportunity. Coming to price points, a large part of our business is in the 1,500 to 2,200 rupee price point, which is a very, very large bulge consumption price point now in the apparel space. That's largely, targeted at middle India. And that's the part of the market which is seeing huge growth, and in new cities as well as the urban centers. So I wouldn't say we are a very premium portfolio. Yes, Tommy, CK are more on the premium side, and they're doing very well there. But the rest of the portfolio is spec'd for middle India, which we believe is the very strong growth opportunity in the years to come.
Okay, Kulin, it's been good chatting with you. Thanks very much. And I'm going to remember that line, profitability perhaps by second half itself, and the business will start throwing up cash. I'm sure your shareholders will really like the sound of that. Thank you for joining in today. Okay, that's Arvind Fashions. In the meantime, the flashes on the bottom of your screen on the 2 new listings. One of them is at the borderline in terms of the issue price. The other one, Aptus, is actually settling below. We'll get those final official rates in the next couple of minutes. But Anuj, let me hand it back to you. Nifty's become very quiet. Bank Nifty absolutely flat as well.
Oh yes, Surabhi. So, it's really been a very volatile day, the Bank Nifty in particular, and I think the mid-cap index for now is trying to hold in the green, but it will be interesting to see what happens over there. I think the stock of the moment is Info Edge, that standout brokerage report that Nimesh mentioned. It's now within 3% of its 52-week high, so that stock is looking good as far as the broader market is concerned. I think Mitesh Thakkar is back with us. Mitesh, morning again. Your reading of the first hour, and what would be your calls now?
Morning, Anuj. See, the first hour has went pretty okay in the sense that we saw opening around that 16,580 mark and then immediately tapered off from there. So that is what we were possibly expecting. I think this is still a market which will need some consolidation between 16,400 to about 16,580, and buying should be advised at lower end of the range, which is close to 16,400, 380 areas. Having said that, trading is stock specific, so I have two calls right now. DVs is a sell with a stop at 48.80 for targets of 47.40, and Escorts is a buy with a stop below 12.77 for targets of 13.50.
Okay, Mitesh, thanks a lot for those calls. Well, quite a bit of profit taking also in market today. Names like Jubilant Foodworks, Dabur, Pidilite, they're seeing some bit of profit taking, and Pharma has started its decline once again, led once again by names like Aurobindo Pharma, but Glenmark, a couple of others like Cadila also seeking lower levels, and the Bank Nifty is once again in the red. Back to you, Surabhi and Sonia.
Okay, Anuj, thanks very much. We'll come back to you. Let's